Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, a video I've been waiting to make for a while about option trading and the precious metals markets. As you may be aware, during my time on Wall Street, worked as an option trader on the New York Stock Exchange for 7 years, part of that time on the American Stock Exchange for complete accuracy, before getting into gold and silver. And there's a trade that I've been doing for a couple of years now with mixed results, but something that perhaps you might want to look into. So before we dig in here, first, a very big disclaimer. This is not legal or licensed financial advice. I'm not suggesting that you should do this. What I'm going to go through is highly speculative. It can lead to 100% losses. And if you are going to dabble in this, please do so at your own discretion or with the help of your financial advisor. Again, I'm just sharing something that I've been doing and continue to look at because I do think there is a great opportunity. But again, do so at your own risk and research this further. Because obviously buying options or even anything involving miners is different than just owning physical silver, which if you're just getting started, I do recommend physical bullion as the place to start. Now with all of that out of the way, given what I just said, why would anybody want to do this? Short version is that back in 2011 when silver hit 49 bucks, gold got up as high as 1900. I did have option positions on gold and silver, primarily GLD and SLV, which I would not use anymore. I'm not sure if when prices move, whether the metal is in those. So again, you may think so, and that's up to you to decide which ones to use. But when I had the options on and the prices were going higher, there were a couple times that year I thought, maybe, again, this is back in 2011, that maybe I might be headed towards some early retirement. Of course, when the metals got beaten back down, lost a lot of what I had there. So it's not a trade for the faint of heart, but to dig in and just give you an idea of what we're talking about and what we're looking at, here's an example I've been thinking about in particular for the past couple of years. You can see here is the chart of First Majestic Silver. And as you see back in 2016, First Majestic was actually under $3 in January. Let's take a look at my ticker over to the side here. Down on January 19th, 2016, First Majestic trading at $2.51. And you can see it had quite a rally up to over $18. Let's see what the high I have here in August. Looks like the highest close was $18.42. August 9th, 2016. So it went from 2.5 to 18, over a 6-fold move. Why did that happen? Well, primarily, and again, I say primarily, here's the chart of silver. Silver went from $14 to $20 by August. Obviously, First Majestic Silver is a silver miner, so has a high leverage to the stock price. Again, there are always other factors involved in the miners. It's not just straight bullion. If they find metal, you're going to have one outcome. If they don't find metal and silver goes up, maybe you have a different outcome. So again, I am simplifying things greatly here. Although going forward, we'll talk to a couple folks. Hopefully can get David Morgan on to run some of these assumptions by him or some of the other silver analysts. So again, I'm just giving a base case so you can see the idea, again, if you would like to look into it further. And now I'm going to stop the disclaimers and just get into it. So hopefully we're good there. But as you can see, silver went from 14 to 20. So a $6 move in silver. And First Majestic Silver basically had about, let's say, a $16 move, which again is one of the advantages with the miners. Some of them have been really beaten up. So when you get a big move in the price of silver, a lot of these miners are going to do things like what we're looking at here with First Majestic. And what I wonder, again, this is my own belief, you may feel differently, but pretty much since 2011, where silver hit $50, following Ben Bernanke's second quantitative easing program. In my opinion, the only reason it came down from 50 bucks was because the banks sold a lot of paper that I don't think that they can deliver. We have Deutsche Bank trading records indicating they were bragging about smoking the price in intra-bank, which I think would make that collusion too. Again, JP Morgan's former trader John Edmonds arrested, pled guilty to manipulating precious metals. So not going to get into all of the manipulation today. Either you accept it or you don't, and that's fine. But for those who are seeing it that way, what I wonder is that if silver does go back up to $50 or higher, and you have options on some of these miners, some of the multiples you get are truly stunning, and we're going to walk through a few of them here today. So again, starting with the basic premise, if silver went up $6 and First Majestic went up $16, which is not a guarantee of how it happens going forward, but just using that as a template, I wonder what would happen if silver went up to $50. What would, you can think about what might be a price of First Majestic. To keep things simple though, again, you saw when silver went up $6, First Majestic went up about 3 times as much. So certainly I would think that when you have silver at $50, some of these miners would go up more than 1-to-1. But just to keep things conservative, let's say that if the price of silver went to $50, that First Majestic was then trading at $50, which to me seems like a pretty reasonable assumption. Again, feel free to insert whichever miner you like. But at least going with those parameters, let's take a look at how some of the option pricing might play out. Again, the way I think of this is it's kind of like having an insurance policy. Because if you buy, especially, there's a bunch of different strikes and options you can buy. But if you buy out of the money call options, expecting a big move, there's a time expiration. So right now, this chart we're looking at is for April 18th of 2019. So basically we're in December now. So about 4 months. If you want to go out longer, you could get July or Jan of 20, Jan of 21. But essentially all these expirations here, you can think of it as an insurance policy that expires on that date. And if you get an event or a big move in the price of silver before that happens, you can win big. If silver's still sitting around 14 bucks when expiration rolls around, you're probably going to lose your entire premium if the underlying equity does not move. So again, this is the kind of trade where it's a good thing if you can have coverage and just roll it over, where maybe you spend $1,000 and you buy options in April. It's not your entire bankroll, but then let's say it doesn't happen by April, and then you just buy another policy that covers you for the next however many months. And then essentially, if you can keep rolling that, then whenever silver does move, you would be covered. So that's kind of how I approach it. And to dig into some of the pricing, let's look at, here is the April 10 strike. You can see there's no bid, and it's offered at 10 cents. And possibly if you put a nickel bid in there, you may get filled. So we'll go with that for now, or even we'll put in the dime bid, which you could, here's the ask, meaning right now you could pay a dime to buy the First Majestic April 10 strike call. And how that works is that if First Majestic is at $12 by that expiration, your call would be worth $2 because the option gives you the opportunity to buy the stock for $10. It's trading at 12, so you've captured $2. Again, if the stock's trading at $5 and hasn't moved, or $7, it would expire worthless, out of the money, and you would lose whatever you paid for those options. So let's take a look at the 10 line. Here I have my option pricing sheet, which is not quite as daunting as it may look here. And it's pretty simple. Up here is the option price is 10 cents. Keep in mind each option contract is for 100 shares. So 100 times 10 cents is $10. Then there's 100 shares behind each contract. So basically buying 100 contracts at a dime is a cost of $1,000. Down here, we're looking at the 10 strike. And as discussed before, we're going to imagine whether it's April or whichever date. In this case, we're looking at April. We'll say maybe things go well. The big move in silver happens. And again, we were going to use a 1-to-1. Silver hits $50 for this example. We will put a stock price for First Majestic of $50 as well. Again, you can change this sheet to any price and parameters that you want. So in either case, that's what we're going to use for now. So the intrinsic value, again, if you're buying the 10 strike, which means you're buying the opportunity to buy First Majestic stock for $10 at or before that expiration. If it goes up to $50, that contract is going to be worth $40. Quick note, there is also a volatility premium that gets factored into all of the prices of options. We will not, just to be clear, I do recognize that. We'll leave that aside for today just to get the main point here. But certainly if you are into options trading, something that you want to be aware of, and you can contact me at the link below on the website to ask any particular questions on that. But hopefully that makes sense. So if that happened, you would have paid 10 cents for something that is now worth $40, which means that your weighted average multiplier would be 400, which means that if all of these events played out to these parameters, you would have a total of $400,000 at the end of a 400-to-1 multiple, which, again, if silver goes higher than $50 and First Majestic goes higher than 50, you can see the numbers get pretty big. In fact, I've wondered if, again, there is the timing. So certainly you could buy these, and if by April, First Majestic still at $6 or $7, you lose your money. Although what I've put in here is way to calculate that. So let's say maybe you think there's a 10% chance that the scenario I just outlined occurs, and a 90% chance that essentially that scenario does not occur and the calls expire worthless. So essentially, if you look at all trading as a science of probabilities and you do a weighted average, so here, okay, there's the 10% chance of 400,000, 90% chance of 0. Your weighted average would still be leaving you with an expected 40-to-1 multiple, which is why, to me, again, I'm a big believer that silver necessarily is going to have to rise in price. So I'm willing to buy options for April or January if you bought January of 2020 right now, you'd be getting a year coverage. Obviously, you'd pay more for your option price, but if you think that it's something that's inevitable and is going to happen and you have options on, it really is stunning some of the multiples you get. By all means, you can email me and I will send you this sheet. You can take some of the other miners that you look at, put your own assumptions in, see what makes sense. But to me, it's worthwhile. All right, let me be careful about that. To me, I continue to put this trade on, and I usually have at least some option position at all times, so that, again, the timing is the tricky thing. We could wake up tomorrow and there could be a short squeeze in the market, or maybe it gets dragged on for a couple more years, which again is why, this is not what you take your entire retirement savings. Do not mortgage the house to pile this on. Yet, even if you just pick a miner you like, find an option you like, and spend $1,000 or whatever amount is appropriate for you, and have the ability to continue rolling that over, if those assumptions of a higher silver price do manifest, then again, certainly you can see that the numbers can get pretty big. Let's take one more look. So here, back to our original example, although let's say you bought those calls for 5 cents instead of a dime, and now you see here your cost went down because we're paying, so we'll increase the number of contracts to 200. So we're still talking about $1,000 investment. If you bought them for a nickel instead of a dime and those parameters played out, now you're looking at an 800 to 1 multiple on your trade, which is obviously quite stunning. I wonder if you have a big move like this, my main concern would be, do I get paid out by the OCC, which is the Options Clearing Corporation? Because certainly the markets are not pricing in even the chance of a big move. So you wonder, if you put something like this on, someone has got to be on the other side of that, and hopefully they don't get blown out and you don't end up getting paid on your trade. One thing I've kept in mind is that should this scenario hit, I would be quick to be on top of my trade of what I want to pull off the table. Again, silver goes up to 50 and then comes crashing back down. You know, you can see your 801 multiple reduced very quickly. And again, I think there is something to be said for making sure you do get your money out of that trade, because we're talking about a scenario where if the dollar is really fracturing and a lot of Wall Street is crumbling, how does that play out? There's a lot of unknown. So that to me is more of the risk than at least the numbers here, because again, as a big fan of silver, and in case you're wondering why, the link to that report is also below in the video. But as a big fan of silver, I think this is bound to happen eventually. Personally think sooner than later. I would be stunned if we don't see some movement in the price in 2019. I've been stunned that it has not happened yet. And certainly a lot of the experts that I talk with on the Inside the Markets show that I do agreed with that. Many folks saying they're surprised it's gone on as long as it has. So I factor that in. Maybe I think it's imminent, but it can go on longer. So all sorts of things you want to be thinking about carefully before you even consider something like this. Yet, again, if you do see prices of silver substantially higher, or this could work for any asset, it doesn't have to be just silver. But if you do see the prices of an asset moving substantially in a way that the market has not priced in, hopefully this video is helpful in just showing how you can get some unusual multiples. Again, you can lose your entire capital if your trade does not play out in the given time frame. So some risks, yet also a lot of opportunity. I will be continuing to put it on, and if anyone wants to discuss that trade, leave your comments below. Look forward to hearing those. And with that said, we'll wrap up for today, but been wanting to do this for a while, and hopefully it's helpful for folks. And with that said, leave your comments below, and I will talk to you again soon. Thanks so much.